Good morning. Welcome to Stock Market Today for Friday, March 6th, 2020. Thankful to be getting to the tail end of this week. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities were sharply lower in Thursday's trading, falling by more than 3% on the day. Financials and industrials were the weakest performers. Defensive sectors and healthcare outperformed, but all sectors did close lower on the day. Treasuries were stronger with the curve flattening and the 10-year yield remaining under 1%. The dollar is weaker on the major crosses. Gold was up 1.5% in a flight to safety. WTI crude was down 1.9%. As we get to the desk this morning, futures are lower by about 2.5%. February non-farm payrolls report came out better than expected, but it seems most investors are looking past that number. Asian markets were weaker overnight. European markets are also under pressure. Treasuries are extending their rally, with the yield on the 10-year note actually falling towards 0.7% earlier this morning. Dollar is weaker on the major crosses. Gold is up 1.1%. WTI crude under pressure once again, down over 4%. So structure of the S&P 500, two-way volatility persists as we are now doing the dance with the 200-day moving average. That's the line here. Support is in the 2,900 to 3,000 range, and I will note futures are trading down around 2,930 here this morning. Resistance in the zone between 3,100 and 3,200. Yes, I realize these zones are wide, but volatility has substantially picked up here in the marketplace. So trying to keep an open mind. RSI is still in bearish ranges here, actually starting to tick lower once again after exiting an oversold condition. Chaikin money flow, same story, exited bearish ranges, but now starting to move lower once again. It is still bullish, but moving towards the downside. We've been highlighting the fact that we think the odds are elevated, that the lows from last week will be retested. Futures obviously under pressure here today. And what we'd want to see, we've been talking about it, is on a retest, we want to look for less intensity in the selling pressure to give us a clue that perhaps a stable base is beginning to form. But right now, futures under pressure, looking past the stronger than expected non-farm payrolls report. Two-way volatility remaining the name of the game. Our market in a minute now. What are we writing about in the note today? Well, stocks dropped by more than 3% as risk aversion remains a key dynamic in the market. Every Friday, we look at key themes and relationships in the marketplace to get a sense for investor risk appetite. And risk aversion has been and remains the name of the game. And you can clearly see that as investors seek the safety of treasuries. Healthcare services is actually an industry group that we're going to focus on today. We're looking for areas of the market that are holding up the best while the market is under pressure and volatile, because those are likely to be, not guaranteed to be, the leaders when the market does stabilize. But as we said, futures do point to a lower open here today. Taking a look at the picture from a power bar perspective, Dow loses 3.5%, one bull to seven bears. S&P 500 down 3.3%, 36 to 113 bulls to bears there. Nasdaq's slight outperformer, down less than the overall market, 10 to 19 bulls to bears. Small caps actually a small outperformer as well, 144 to 422 bulls to bears. There's your flight to safety right here. Bond prices up by 2.5%, sending yields lower. Again, the 10-year firmly below the 1% level. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bearish. Major markets are mixed. Taking a look at our stock of the day now, auto-generated based on its power gauge rating and its First American Financial. It's an insurance company. Closed at 65.63, up 2% yesterday. So a big outperformer, very bullish stock, strong trend. Why are we very bullish? Well, due to strong earnings performance, very positive expert activity, as well as attractive financial metrics and strong price volume activity. So when we roll up the 20 factors, we come out with that rating. Now, something that's interesting to me that I'm trying to point out whenever I see it is stocks that are holding above their long-term trend line. Not a lot of them these days, but there are a few, and we're going to try to find them. More interestingly, though, is this is what we're looking for. We're looking for the stocks where relative strength is moving higher as the market is under pressure. Those are your leaders. Those are your stocks that are holding up the best. Now, in some cases, it means they're just going down less than the overall market. But regardless, the stocks that are performing the best on a relative basis have the strongest potential to be your leaders when the market does stabilize. So we want to look for names like FAF, right? Rounding out of an oversold condition. Chaikin money flow mixed is slightly bullish, right? So we have a very bullish stock outperforming with slightly bullish money flow that's holding up pretty well here in light of everything that's going on in the marketplace. So these are the types of names where if you are looking to put money to work, these are the types of names that should be on your radar. As always, you should be managing risk, right? However you choose to do that. And honoring your risk management discipline. I think it's really important at all times, but especially when we've had these 3 and 4% shifts in the marketplace. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. Well, the top four kind of paint the picture that we have been and continue to talk about. Flight to safety, right? Utilities, obviously declining yields helping that group. But that's a safe haven within the marketplace, and it's outperforming up 5.25% over the past 5 days. Staples, another safe haven. We're going to take a look at that in a little more granularity a little bit later in the show. Healthcare, again, most parts of healthcare, or a lot of parts of healthcare, are viewed as safe havens in times of uncertainty. Healthcare continuing to hold up well. We're going to look at services in just a bit. Real estate, falling yields help, but again, safe haven. Middle of the road, tech materials and comms all higher. Tech, obviously, is important as the largest weight in the index, but tech has actually held up on a relative basis, i.e., it's gone down less than the overall market. Discretionary under pressure. Energy continues to be under pressure. We want to avoid it. Industrials, obviously, a very cyclical area of the market, under pressure both on an absolute and relative basis. And then your financials, I mean, there's nothing we can say about it. Financials are a broad group, right? So you do have to drill down. Parts of financials are holding up, right? Like insurance. But the banks are really weighing on the group in general. Financials lagging down by 3.22% over the past 5 days. And with interest rates moving lower, it's hard to make the case for the bank portion of financials here in the near term. Looking at our industry and focus now, speaking of healthcare, speaking of defensive healthcare services, which has the added element of starting to benefit from the fact that Bernie Sanders is falling off in the polls for the Democratic nomination. So healthcare services over the past 6 months has outperformed the S&P 500 by 4.34%. Its power bar ratio, which measures future potential, is strong, right? 11 bullish stocks and 9 bearish stocks. This group is currently ranked number one of the 21 subsectors that we track, having moved up 3 slots over the past week. And now the names that you see here that are indicative of the group or should all be familiar because they were all the names that were the big leaders when we looked at the movers and shakers yesterday. Centene, CNC, very bullish. Humana, HUM, very bullish. And Cigna, CI, also with very bullish Chaikin power gauge rating there. So it's an area of the market that's holding up well, right? Obviously tied to some of the political developments that are playing out and will continue to play out as we get to the November election. But I wanted to take a look at a name again, right? Speaking of names that are holding up well, I want to show you examples of the types of names that you should be adding to your watch list and be considering. Centene has a very bullish rating and is in a strong trend above this trend line. It's oversold with bullish money flow, but check out the relative strength. Look at the pickup in relative strength as the market has sold off, right? This is a type of name you want to consider on the long side of the portfolio. Should we begin to see signs of a stabilization in the market? Should we begin to see signs of a less intense low on a retest of the levels that we saw last week to the downside? Centene, type of name you want to have on your watch list, type of name you want to consider, right? Solid support in here in the $50 to $55 range, trading above it right now, oversold, and the outperformance is where we are keying. Look for names like this. For those of you who use Chaikin Analytics, for those of you who have taken part in the 14-day trial, you can use our screener functionality to look for names that have exhibited strong relative strength that are likely to be your leaders when the market does stabilize. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers. The grocers have been doing well as people have been stocking up on supplies. Kroger up 8.11%. Citrix, didn't see any real news there to send that stock higher by 6% on the day. Same goes for A.O. Smith. A.O. Smith, a very bearish stock, but up 2.61% yesterday. So some solid outperformance there. Nothing company specific. Newmont traded at a new 52-week high yesterday, rallying with the price of gold. And Clorox is a coronavirus play. We've definitely seen some number one, a flight to safety. It's a consumer staple. Number two, it plays to kind of cleanliness and killing germs. Number three, Costco's commentary yesterday also helped that name. Clorox up nearly 2% on the day. Loser side of the board. Well, the top four are very thematic in nature, just like the winners were thematic yesterday. The losers are thematic today, and they are coronavirus related. Royal Caribbean, not a lot of people rushing out to take a cruise these days. Royal Caribbean also caught a downgrade and traded at a 52-week low yesterday. Carnival Cruises, same thing, 52-week low. Impacts of coronavirus. Also, the CDC is looking into one of their ships. Is one of the passengers there has come back with signs of coronavirus. American Airlines caught a downgrade at Bank of America Merrill Lynch, again part of the travel and leisure area that's been under immense pressure, down 13.44%. Norwegian Cruise, you get the point. Norwegian down 13.4% as well, trading to a new 52-week low. IR didn't see anything company specific to drive that stock lower by 13.25% yesterday. So let's dive in. Like I said, on Fridays, we look at the key themes and relationships in the marketplace, and the key theme is going to be risk aversion, right? The first way that we can see risk aversion in the marketplace is the performance of high yield bonds relative to treasuries. HYG is the high yield bond ETF. IEF is the 7 to 10 year treasury bond fund, and it has broken down through support below the 200-day moving average in a move that is confirmed by momentum as the RSI became oversold and continues to trade in an oversold position. So momentum confirmation to the weakness that we are seeing as investors gravitate towards safe havens, right? High yield bonds certainly not going to be confused with a safe haven as opposed to treasuries, which are, and this is all largely playing out as treasury yields have precipitously fallen now, breaking below the 1.5% level, breaking below 1%, traded down as low as 0.7% this morning in an ongoing flight to safety on the part of investors, right? So when we do see the market start to stabilize, we'd expect to see a stabilization in this ratio. So far, we're not seeing it. We are on the lookout for signs that it is taking place, but so far, it's just not the case. High yield continues to underperform treasuries as investors flock to the safety of treasuries in the marketplace. What about another area of risk aversion? Discretionary versus staples, right? And we're looking at this on an equally weighted basis here to account for the fact that Amazon is 25% ish of the consumer discretionary sector. And what we can see is a clear downtrend that has now accelerated to the downside. When discretionary stops are lagging staples, that's a sign of risk aversion in the marketplace. If we just kind of think it through very simply, discretionary sells products that we want, right? So if you're worried about the economy, right, you'll start to look for areas of the market where you might want to cut back on spending. Largely, that would be those would fall into the discretionary area of the market, as opposed to consumer staples, right? These are the products that we need, right? Clorox coming to mind, right? But food, soap, shampoo, products like that, the things that we need on a daily basis, those stocks should tend to hold up better, at least on a relative basis. And to me, it's a way to measure risk appetite in the marketplace. And we can see a clear downtrend below the 200-day moving average. And here again, the move is confirmed by momentum. Notice that when we tried to rally through the fourth quarter of last year, RSI never really became overbought and is now oversold. So momentum to the downside of his investors take a more risk averse stance in the marketplace. But again, one of the data points that we'll be looking at for signs of stabilization should the market begin to make a less intense low on a retest. And finally, same story here, high beta versus low volatility, right? If you're an investor and you're concerned about the market continuing to move lower, but you have to stay invested like a lot of professional money managers do, well, it makes sense to gravitate towards the lower volatility names that are likely to go down less than the overall market so that your relative performance can stay on track. Well, high beta, lagging, low volatility, as we can see in this chart, downtrend clearly in place below the 200-day moving average, now breaking support as the RSI shifts into bearish ranges and moves towards an oversold condition. So again, just investors risk averse. Those who have to be invested are gravitating towards the names that are likely to go down less than the overall market. That'll wrap us up for today. Head over to chaikinanalytics.com where you can sign up for a 14-day trial. Chaikinanalytics.com/test drive. I talk about a lot of this stuff every day in my weekly notes, as well as access to calls with myself and my team. I hope everybody has a great weekend. I will be back here with you on Monday. Have a great Friday. Have a great weekend, everyone.